Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump says he's likely to impose tariffs on pharmaceuticals as soon as the end of the month, with semiconductors also in the firing line.
Pharmaceuticals will be tariffed probably at the end of the month, and we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff.
Well, joining us now is Karim Chedid, head of EMEA investment strategy at BlackRock, and Rosalind Matheson, our EMEA news director. So thank you both for joining us. Ros, where are we on tariffs? It seems the market is not too optimistic that there are deals to be had.
Well, it's interesting because you were seeing in the CPI data out of the US yesterday just that start to show up, that companies are changing behaviour, consumers may be starting to change behaviour. I mean, the overall numbers were benign, but there are some elements there. And we can see this also now that Donald Trump's talking about pharma as well. So on the sectoral side, it's not just steel, aluminium, it's also copper. Potentially, he's talking about chips, he's talking about pharma, and he's saying we'll start low and maybe go up, and maybe we'll start this in a couple of weeks. But all of that's going to mean higher costs for consumers in the US. If you're buying drugs, if you're buying tech goods, whatever it is, all these components feed into the end user in the US, and they are the ones who are likely to be paying the most. We know that some companies in Asia are choosing to absorb a bit of the cost, but we're heading towards that moment where we're going to see it start to really impact. And that's really going to be interesting to see the US reaction from Donald Trump and others to that. If it starts to show up properly in the US economy and in US markets, does that allow them to change course or does it prompt them to change course, or are they continuing regardless?
Yeah, and Karim, this is a good point. I guess, for the moment, the market is cautious, partly because of that inflation data in the US. Nothing huge, but again, we could start seeing the signs of tariffs impacting. And I guess the market is also taking a pause because we've had, record high after record high.
Yeah, I mean, building on Rosalind's point, this is the framework we're thinking about, whether who's tariffs as we start to see some lasting impact. Is it the consumers, is it the U.S. corporates, or is it the exporters? I'd argue, looking at the earnings season that is about to kick off with European earnings now predicted to decline on the quarter and on the year, some of the exporters are already seeing this negative effect through the drop in the dollar and the higher local currency that is impacting their exports, or at least predictions of. And I'd argue that we started to see some of the impact show up in CPI, such as the US CPI release, although still not broad, and we still expect more impact to come through in H2. And ultimately, the key word here is dispersion. There will be winners and losers and opportunities that arise on dispersion, on active management of the balances.
Karim, we've also had some pretty, discouraging figures out of inflation in the UK, unexpectedly jumping. I mean, how much of this is domestic? So how much of it is actually the tax hikes from Labour taking their toll on, grocers and retailers? And how much of it is actually tariffs and trade?
So when we look at the under the hood of the UK numbers, of course, there's been a well-telegraphed pickup in food inflation and also in energy base effects coming from a lower base. So we do have to take these into account in the number, but also some early signs of the impact of trade friction. We don't think that the number derails this BOE baseline of a still gradual cut. So we're still expecting a cut in August. The market is pricing 2 cuts by end of the year. But of course, this does make the trade-off a bit more difficult.
We also, of course, Rose, have a lot of questions about, how and when Jay Powell will be replaced. Yesterday, we spoke to the U.S. Treasury Secretary. And so just for everyone to remind ourselves, basically, the Fed chair's mandate comes to an end, but he could stay on as governor. And, of course, the Treasury Secretary said it'd be great if he just left full stop. Here he is.
Traditionally, the Fed chair also steps down as a governor. And there's been a lot of talk of a shadow Fed chair causing confusion in advance of his or her nomination. And I can tell you, I think it'd be very confusing for the market for a former Fed chair to stay on also.
I mean, to stay on, basically, this gives Jay Powell leverage so that I guess they don't pick just anyone to replace him.
Well, that's right. But the question is, how much leverage does he have in who they decide? It's very clear they just want him gone, period. And they want him gone ASAP. Donald Trump has walked back, any threat to fire him that was in the ether a while ago, or to try to fire him, rather, and that's disappeared. But as soon as his term's up as Fed chair, they want him out. And they're going to push every which way to make that happen. And they'll make it quite uncomfortable for him. I mean, obviously, he's withstanding the kind of insults that they're putting his way almost every day. Donald Trump called him a stiff yesterday, and has criticised him repeatedly. He's withstood all of that, but he probably would move off at that point. Also, just to allow the new Fed chair, whoever that person is to have the lay of the land. I mean, the question is then, who are they going to be leaning towards? Even Scott Bessent, although Donald Trump indicates he wants to keep him where he is. So the conversation that we're hearing is really around Kevin Hassett from the National Economic Council, someone who's very much in Donald Trump's orbit, in his ear, very much echoing what Donald Trump is saying about rates. I mean, Hassett's view is that the Fed is independent, but right now he thinks it's not acting independently because it's not doing what it should on rates for political purposes. And so he very much is the front runner that we're hearing in this sort of apprentice-like contest, maybe, to become the new Fed chair. But it's going to become quite an awkward period, especially as we get more into 2026, that's for sure.
Yeah, you're so right. It does feel a bit like The Apprentice. We should film that. I would 100% actually watch that. And let's also talk about France, where the Prime Minister has outlined plans to scrap 2 public holidays, mon Dieu, along with spending cuts and tax rises to repair the nation's public finances. Now, François Bayrou says the country is addicted to public spending as he tries to tackle the Eurozone's largest deficit. Now, we spoke with France's finance minister a little bit earlier.
We are tackling the issue, I believe, very seriously. The plan is a plan of 44 billion euro of savings and revenue increases. 44 billion euro that will bring our deficit below the 5% threshold next year to 4.6%, and we are aiming at a deficit below 3% in 2029.
I mean, that's the numbers, but they're also trying to get rid of 2 public holidays. So let's get straight to our Paris bureau chief, Alan Katz. Alan, I mean, can the government even survive with some of these budget plans?
I mean, that's the $64 million question, Francine. And I think your mon Dieu response was actually what Bayrou was going for in this announcement. I mean, he really did make sort of a maximalist announcement, the kind of thing where, like, he's not setting out. In some ways, I guess it's almost Trump-like, because he wasn't setting out the actual policies that are going to be voted into a budget at the end of the day. As Pierre Moscovici, who was on just a little bit earlier, mentioned, this is the starting point for discussions, and whatever budget is voted at the end of the day, hopefully by the end of the year, will likely be very different from what Bayrou presented yesterday. But that said, he sort of laid out, as you pointed out, this idea that France has been addicted to debt, that it really is headed towards a cliff edge, and if they don't do something, then it's all going to end in tears, as it did with Greece, more than a decade ago, or with other European countries. And so they really have to avoid that, or that's Bayrou's plan. And in this budget, there are several things that are really going to make a lot of people angry, including the holidays that you mentioned, and a couple of things that might make people actually relatively happy. So to go over the things that are going to really make people angry, first of all, and I'm talking about public opinion broadly here, one is getting rid of 2 public holidays. I mean, that's not going to please anybody in any country. And France has 11 public holidays a year. That's the same as the United States, though more than in the UK. But it's not sort of out of the norm in terms of the number of public holidays. But what it does have is a lot of them concentrated in the month of May. As you know, Francine, if those holidays fall on a Tuesday or particularly on a Thursday, so you day off on a Thursday, then you have Friday, then you have the weekend, the French will often take the sort of that 4-day long weekend, and it's called a bridge in France, prendre le pont, or faire le pont. And so it really does have an impact on productivity in the month of May, the statistical impact that the National Statistics Agency follows. And so if they get rid of a holiday or two in May, it really could have an impact on French economic output over the course of the entire year. The other thing that people are really going to be mad about is what's called an année blanche, which is where you don't raise to follow inflation retirement payments or welfare payments, you don't change the tax brackets, et cetera. And that affects a lot of people. And it's one of the things that Bayrou's predecessor, Barnier, one of the reasons why the National Rally ended up voting against him and booting him out in a no confidence motion, because he was also trying to do that same thing. So it's very dangerous for Bayrou to have done that.
So interesting, Alan. Thanks so much, Alan Katz, there, our Paris bureau chief. Now let's get back to Karim and Roz. Karim, again, French governments have been kicked out for less, but at the end of the day, how is France investable unless you get some of the reforms through? Like, what are your thoughts on European companies and productivity in general?
So I'll break this into the stock market and the bond market. On the stock market side, if I zoom out, we've been seeing a pretty big repatriation of flows to European equities. This is including France, but also broader at the broader continental European equity level. And this is something that has been very apparent in the ETF flows. If you compare the flows into European equities this year compared to last year, we're talking about a jump by fourfold for European equity flows. Now, the gap between that and U.S. equities has started to shrink. I'm talking from EMEA investors, from European investors' standpoint, in the past couple of weeks, in anticipation of good or better earnings from the U.S. equity side, but the gap is still quite big. So very much a home bias from Europeans this year, which the French news has not really disrupted. On the bond side, of course, there is a spread that has opened up between the OATS market and other sovereign markets in the region. We've been seeing a lot more of a focus of a carry trade on Italian and Spanish bonds rather than French. The question becomes, at which point does the news become a good entry point for OATS? Perhaps it's not today, but something to look at.
Yeah, and Roz, this goes back to, we heard from Ada Boutin yesterday about, competitivity in general in Europe, but this also goes back to, if Europe is going to get better, especially when it's getting attacked from all sides on trade and tariffs and other things, then some of the reforms need to be in place, but then they also have to answer to voters.
Well, that's right. We saw Jamie Dimon, of course, last week being quite critical of Europe in some comments, saying that Europe is still failing to grasp the moment, that they're falling behind on competitiveness. And they still, in the end, they talk about all these unions. They talk about banking unions. They talk about making a lot of things easier, dropping regulation across the board. And they all want to do that as long as it doesn't affect their own companies too much. They talk about banking champions, but they don't want to do it if it's their own banks, as long as it's someone else's banks who are taking the lead. And we saw that with Germany recently, saying we don't want to be on the hook collectively if a bank outside of Germany fails. So we don't want to sign up to a joint mechanism on that. So there's a lot of talk about joint work and not a lot of action when it comes down to it. And that really is the challenge for Europe on the competition front, is to say we're going to stay united on all this. Even if it affects us individually negatively, it's for that greater good. And that was kind of the point that Jamie Dimon seem to be making. There's a lot of potential in Europe. The markets obviously this year have been very good in Europe. Companies are doing relatively well, but there's still that structural problem with going to that next level.
Roz, thank you so much. Of course, our Roz Matheson and BlackRock's Karim Chedid going through all of the stories, and there are many today. Now, second quarter earnings releases are pushing Wall Street bank stocks in divergent directions, with another batch of the biggest lenders set to report this morning. Our Charlie Wells is here with the latest. Charlie, you've been combing through the results. JP Morgan, Citi and Wells Fargo really setting the stage for today's results.
Good morning, Francine. So yes, that split that we're seeing in share price performance is really striking when you take a look. You see Citigroup having its best day, hitting its highest point since the financial crisis in 2008. You contrast that with Wells Fargo. They had their worst price performance in the market for an earnings day in 4 years. JP Morgan somewhere in the middle with a solid report and the ability to beat on investment banking. If you ask why, you can dig into the Wells Fargo report, why they did not perform well in the market. Investors really focus on that net interest income figure. They did not beat on that. They missed, and they had to lower their guidance on net interest income for the year ahead. But there was a bigger picture issue here with Wells Fargo, and it was the issue of that Fed-mandated asset cap. There'd been a lot of excitement from investors about what could happen in this first quarter when the bank was reporting without that Fed-mandated asset cap. But you've got Charlie Scharf, the CEO of Wells Fargo, pushing back, basically pleading for patience here, talking about how the removal of that cap is not the same as just flipping on or off a light switch. So asking for patience there. The flip story with Citigroup, they were able to announce a $4 billion share buyback. Investors were very pleased with that news.
So, Charlie, what are analysts expecting from Goldman, Morgan Stanley, and Bank of America?
Francine, the pressure is on, particularly after that JP Morgan beat on investment banking revenue, beating expectations by some 23%. We are expecting to see, at least according to analysts, growth in investment banking from Goldman Sachs, from Morgan Stanley, but this just adds pressure to that JP Morgan beat. We're also expecting to see growth on the trading front. There's been a lot of volatility over the past quarter. We're really expecting to see strength from the likes of Morgan Stanley, from Goldman Sachs on the equities trading front. And I want to turn our attention to Bank of America, also reporting in just a few hours. This bank has been relatively unloved in the market up this year, but not quite as much as its peers. Analysts have a very different take here, indicating by the number of buy ratings that we're seeing from consensus that something might be misplaced. And so this disconnect adds gravity to the earnings report that we'll get our eyes on in just a few hours.
Charlie, thanks so much. As ever, Charlie Wells there with the bank earnings. Now, coming up, we'll discuss support for Ukraine, as well as the impact of President Trump's tariffs with the president of the European Bank for Reconstruction and Development. That interview is up next, and this is Bloomberg. Well, as the war in Ukraine continues, the European Bank for Reconstruction and Development has boosted its support for the country. Now, the EBRD has committed another 400 million euros of new funding for Ukraine, raising its total support since Russia's invasion to more than 7.5 billion euros. Well, I'm now delighted to be joined by the president of the EBRD, Odile Renaud-Basso. Thank you so much for joining us. I mean, there's a lot as we try and monitor basically every day what's happening also on the ground. President Zelensky, after the attacks overnight, saying that energy infrastructure has been hit in this overnight attack. I mean, it's very difficult, of course, in an active situation to assess how much and how badly. But what are you seeing on the ground?
So, no, I think what we see is an intensification of the attacks, also on civil people. So, attacks on infrastructure have been there for quite a long time. They have been intensifying, but also now more attacks on the cities, on people, on housing, and so forth. So this is very worrying because, of course, this has a big impact on the morale, on the feeling of safety, and it calls for this enhanced support to get protective tools. Patriots and so forth.
Yeah, and we've talked about this before, that it's actually quite difficult to start talking about rebuilding or to use some of the loans when you're still in an active war zone, that you don't really know which way it goes. So how has the conversation evolved in the last 2 to 3 months?
So, I mean, what is very clear is that you need to rebuild already now. And we already discussed that, because when things are destroyed, you need to repair them in order to keep electricity functioning, in order to keep the railway functioning, and so forth. So that's what we've been doing. And on the 7.6 billion euros we've invested in Ukraine, more than 2.6 billion for energy, on electricity infrastructure, decentralized electricity generation. That was one of the loans we signed in Rome with a company to produce electricity from gas pickers and so forth.
And some, I mean, again, the commitments bring the total EBRD financing deployed in wartime Ukraine to 7.6 billion euros, which is a big number. What kind of, conversations are you having with the U.S.? For me, it's unclear where the Trump administration actually stands on helping Ukraine.
So I think that what we've seen in the last few days is a positive decision to deliver some military support to Ukraine with this military support equipment being bought by European, basically. But what we see, in our, the US are shareholders of the bank, and in our governance, they support a project for Ukraine. They continue to support investment in Ukraine. And we are working also a lot with DFC, the bilateral agency for US support. And we've been working, and I think we are discussing new project in Ukraine also with them.
Do you see any waning support actually for Ukraine given the tariffs imposed by the Trump administration or the negotiations with Europe?
Any impact on the support to Ukraine? No, I think that the Europeans really understand that they need to continue to support Ukraine for the long run, that it's absolutely, they are very committed to help Ukraine during the war because they see the strategic impact of the war for Europe. So I think that there is a strong support for budget support, for military, for budget support, and we receive a lot of guarantees from the EU also to help us building, our activity and increasing our activity and our risk appetite in Ukraine.
And that hasn't changed?
No, that hasn't changed. On the contrary. I think this is the consistency of the support is there. It was very impressive to see in Rome the Chancellor Merz, President of the European Commission, being there with Zelensky, Giorgia Meloni, and so forth. So the European determination, I think, for the strategic connection with Ukraine is there.
Can you give us, and I know this is a difficult question, but can you give us a template of what you think Ukraine will need in terms of money over the next 6 to 8 to 12 months, given some of the infrastructure is hit, and again, we don't know what happens next?
So it's very difficult to give a template. I think that what we know is that for budget, to cover the expenditure, to be able to pay people, to pay, and support the military and so forth, they need at least 50 billion a year. But part of it is already, I think, with the agreement reached by the G7 last year on how to mobilize the revenues on the frozen asset. So there is some visibility already and some funding available for 25 and part of 26. I think the big question is more second half of 26.
I know if you dig deeper into some of the things that you've done in terms of advisory, but also financial support, there are two transactions with local banks. One is like a risk-sharing agreement. The other one is also a risk-sharing facility with Ukrakas Bank. Could you see more of those local supports through banks?
Yes, that's a big part of what we've been doing to provide risk-sharing, because local banks, they have a lot of liquidity, but they don't want to take too much risk because of their fiduciary duty. So we cover half of the risk. And we've been deploying 2.6 billion, covering 2.6 billion of funding for SMEs. And it's very complementary because we cannot work with, we do not have the local presence everywhere to finance small businesses. But working with local banks has been very effective. Also to deal with this energy crisis, because we had some dedicated facility to support investment from businesses in decentralized energy capacity.
There's a lot of talk about what to do with the frozen Russian assets, whether they should be used actually to help Ukraine. Do you think there'll be some kind of unlocking?
It's a persistent discussion. So now there have been the decision on using the revenues. There are some ongoing discussion on whether there could be more revenues with more risky investment from this frozen asset. And I think the discussion of whether to use them for the reconstruction is still on. It's a very complex decision because of international law, long-term consequences, in terms of euro as a safe asset and so forth. So a lot of work is still going on. But I think for the time being, using the revenues is already a very positive step that needs to be continued.
Thank you so much for joining us. Odile Renaud-Basso, they're the president of the European Bank for Reconstruction and Development. Now, coming up, the Nvidia chief executive praises China's world-class AI after winning a concession from the US on chip sales to the country. More of that next, and this is Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Now, President Trump plans to impose tariffs on pharmaceuticals as early as the end of the month and says levies on semiconductors may come soon. Well, traders trim bets of a Bank of England rate cut as UK inflation unexpectedly rises to its highest level since January last year. Plus, ASML slides as the Dutch firm wants walks back its growth forecast for next year and says demand for chips will grow if the U.S. lifts curbs on exports to China. So let's stay with tech, and the chief executive of Nvidia says he expects to get the first batch of U.S. export licenses soon so it can resume shipments of its H20 AI chips to China. Jensen Huang was speaking after the Trump administration's dramatic U-turn on chip sales to China. Now, he also underlined the importance of U.S. access to the Chinese market.
50% of the world's AI researchers are here in China, and there are so many innovative and dynamic companies here in China. It's really important that American companies are able to compete and serve the market here in China. It's a great springboard for all of the other markets as well.
Well, Bloomberg's Jill Deesis joins us now from on this. Hi, Jill. So what does Nvidia actually, that reprieve tell us about the state of the U.S.-China relations?
Yes, Francine, I think what you're seeing is certainly what appears to be a bit of a de-thawing here. I mean, the fact that, Jensen Huang is in China, you just heard him there talking about Chinese AI. He's said that he met with one of the vice premiers, He Feng, to talk about foreign investment in China. This all coming, of course, on the heels of that H20 chip approval. So this was actually a chip that Nvidia had designed to comply with some Biden-era sanctions on China. It was, blocked earlier this year by the Trump administration, now obviously allowed to go through. I think this in combination, what we heard just the other week from Secretary of State Marco Rubio about, sort of paving the way for a potential Trump meeting with Xi Jinping, the Chinese president, does kind of show you that, there is a little bit of a de-thawing in this relationship. Obviously, tension still remains somewhat there. There are various economic sanctions and such or economic, restrictions and such that exist on China right now from the United States. But we do, in combination with this and then that tariffs reprieve that was reached in Geneva between the U.S. and China, does kind of indicate that, maybe there's some room for that relationship to develop. Obviously, we'll have to see what happens from here. But yes, I mean, certainly good news for Nvidia, and I think somewhat promising, at least in the interim, for the U.S.-China relationship.
Jill, thank you so much. As ever, Jill Deesis there with the very latest on Nvidia. Meanwhile, ASML shares have slumped after the chief executive cast doubt on the company's growth forecast for next year. Now, the company, which manufactures chip-making equipment, reported better than expected order bookings in the second quarter. But the chief executive says increasing geopolitical uncertainty means it cannot confirm its 2026 growth forecast. Now, the company says demand for chips will grow if the U.S. lifts curbs on exports to China. And the French Prime Minister, François Bayrou, has used his budget statement to warn that the country is in mortal danger if it fails to deal with its growing deficit. Now, he revealed debt interest costs would hit 100 billion euros in 2029 if nothing is done. Well, let's now speak exclusively to Citi's head of European markets, Fabio Lisanti, who's based in Paris. Fabio, thank you so much for joining us, as ever. I mean, the Prime Minister of France yesterday was pretty punchy. How do you see this developing?
Good morning, and thank you for inviting me here. So the announcements last night were very much expected by the markets, to be fair. We saw the market reaction quite muted. One area that we look at very closely is the OAT to Bund spread, 10-year, and that did not move. It's still trading around 70, which again is tight compared to what we've seen historically. So I think it was a well-flagged development in the market that this debate would be starting. I think now what we will expect is that the coming months will lead to a more, let's say, volatile environment, because the debate will start. The positions will be made very clear, and hopefully a common ground will be found.
But Fabio, overall, I mean, what is the markets actually looking at? So if the government falls, do they care? Are they looking for a budget, or are they just looking through everything to look at the presidential election to see if there's just a more competitive France and therefore a more competitive Europe?
I think what investors would like is very much a budget which is agreed upon and a government that is able to stand. That will be very much a function of the debate that will occur. If one actually looks at France and the revenues of France as a country and the amount of debt that it sustains, it is actually quite healthy compared to what we see in other jurisdictions such as the US and UK. So it's not so much about debt sustainability, it's very much about the ability of France to put a control around its debt and come to an agreement on a budget which will allow for more debt sustainability in the future.
How will tariffs, which could be as high as 30%, although the European Union is thinking of retaliating or certainly negotiating, how would it impact, French markets, but European markets and companies in general?
Yeah. So I think on the tariff debate, we've seen quite a constructive, although there is a lot of concern, we have seen a constructive dialogue between the administrations, US and EU. And we are hopeful that a common ground is found, which is constructive to the market. I think on the European side, we see tariffs as being deflationary, and actually Europe, if you look at where it is from a growth perspective, our economists, because of the fiscal spending that has been announced, and because of the defense spending that has also been agreed, will actually benefit from a growth in GDP. Next year we've increased our forecast to 1.3% GDP growth in Europe, and that's up from 0.8%. So I think the tariff debate is a very healthy debate, and we are confident that a solution will be found. But Europe, I think, especially also because of the German fiscal injection, will see growth over the coming years. And actually also our strategists, if I look at what they are estimating, they do see a 3% per annum EPS growth in Europe over the next 5 years.
Fabio, I feel like the markets are looking through a lot of things. I mean, if there's a retaliation from Europe, do markets fall, or will they just look through because essentially Germany with the defense spending can carry Europe for quite some time?
So I think the markets are very much looking for an accord to be reached and a reduction of uncertainty and elimination of uncertainty. That's what the markets are looking for, and that's what I believe the policymakers are very much working towards. And markets are hopeful that is indeed the case. We've seen a lot more resilience in the markets and in the debate that is occurring, and therefore I think in general the stability we've seen and the constructive tone in the equity markets really points towards an agreement being reached.
What are you looking for in terms of when you look at opportunities actually in Europe? What's the next catalyst for growth and therefore market opportunities?
So I think that the big story in Europe is really what we was mentioning, which is the fiscal spend that we are expecting in Germany on infrastructure and then the defense spending across Europe. And that will lead to quite a boost to the European economy. It will lead to new employment. It will lead to developing technology. So from that perspective, and what we're seeing today, we're expecting the EU Commission to present their budget for the future in Europe, and that as well will be a great opportunity for the European leaders to come together and show united Europe in creating a more sustainable path to spending, to capital markets, to savings, and all of the policies that they have developed over the last year. I think now is when all of these really come together in terms of policy development and debate.
Fabio, given you're in charge of European markets at Citi, where do you see yourself hiring the most? I know Citi has bet quite a lot on France and Paris. Is it still the case, or are you looking to move people?
So Citi chose Paris as its hub in the Eurozone. London remains our main hub across EMEA. But in Europe, it's very much Paris was chosen, and we're very happy with that choice. We do have a very local presence across Europe with offices in over 20 countries. And where we have placed our trading hub is very much Paris. So we have hired in Paris. The staffing in our Paris markets business has tripled over the past 3 years. And we are looking to continuously strengthen that based on market opportunity. And the move to Paris has been a very constructive opportunity for our markets business across Europe.
Fabio, thank you so much for joining us. Fabio Lisanti, there, Citi's head of European markets. Now, Renault shares have fallen the most since 2020 after it issued a profit warning yesterday evening. The French car maker has lowered operating margin guidance for this year and also cut its free cash flow expectations. It blamed intensifying competition and decline in the auto market. Now, the CFO, Duncan Minto, has been named interim chief executive while the search continues for a successor to Luca De Meo. Now, Meta is headed for another clash with the European Union after a €200 million fine failed to bring Facebook and Instagram into compliance with a tough new digital law. Well, the European Commission wrote to the social network giant last week, cautioning that Meta's pay or consent service, which ad-free services for a fee, needs further reworking. Now, the procedural step paves the way for a formal EU warning and eventually periodic fines if Meta fails to appease regulators. Now on to the UK, where the Chancellor of the Exchequer, Rachel Reeves, has pledged to reform the UK's bank ring-fencing rules to help spur economic growth. Now, the rules were brought in after the financial crisis to protect consumers' money.
I have committed to meaningful reform of the UK's ring-fencing regime, recognising that now is the time to go further in tackling inefficiency and boosting growth, while retaining the aspects of the regime that support financial stability and protect consumer deposits.
Well, let's bring in our London Bureau Chief, Ruth David. Ruth, so good to speak to you. So we heard from the Chancellor yesterday. Is any of this a catalyst for growth?
That's the trillion or billions of dollars question. The big thing, and we've had people in the city that we spoke to yesterday saying that these are all really good steps and they are encouraged by it. Rachel Reeves is actually taking a note out of Margaret Thatcher's handbook, the Tell Sid campaign to get the public to invest more in shares, and she wrote eloquently in the FT this morning about how 30 million UK bank owners are earning 1% interest on their savings. That cannot continue. So she is making these moves to kind of catalyze growth. Ring fencing for banks has been something British banks have been complaining about for a long while because it puts them at a disadvantage to their Wall Street rivals. The big questions are, and all of the details will be in the execution. How soon can they get these done? How can they ensure? She's also talking about, for instance, making it easier for homeowners to get mortgages on lower incomes. How do you put these reforms in place and ensure that you're also guarding against risk?
Yeah, and at the same time, she has like a huge hole in public finances that she has to fill because of the various U-turns. So it's not an easy task the Chancellor has.
Absolutely. Bloomberg Economics estimates that hole is to the tune of 20 billion. When the budget comes around, the questions are going to be if she has said that, and she is known as a chancellor that has held on to fiscal discipline. That's why investors in the markets like her. So she's said she's going to do certain things. She's not going to raise more taxes. But how does she get around to doing that? And also just remember, inflation numbers came in. They are higher than the Bank of England was predicting. And one thing companies are saying is, it's because of the tax rises that she put in. So taxes for companies are already near record highs. If she increases taxes more, including, there's been all this talk around another wealth tax. Do you want more wealthy people exiting the UK? So how do you get that growth while also ensuring that the people who ensure that growth don't all leave the country?
Yeah, it's a fine balance, and people are really waiting for some kind of signal from the Chancellor. Ruth, thank you so much for joining us. Ruth David there, our London Bureau Chief. Now, coming up, Italy's banking sector is at the center of a flurry of European M&A activity. We'll talk to the Monte Paschi Chief Executive, Luigi Lovaglio. He's coming on next, and this is Bloomberg. Welcome back, everyone. Now, Italy has emerged as the center of European banking consolidation. In a dramatic turnaround, Monte Paschi, the world's oldest bank that was bailed out by the government in 2009, has made a bid for its larger rival, Banca. Now, leading these efforts is the chief executive, Luigi Lovaglio, who I'm pleased to say is joining us now. So, Mr. Lovaglio, thank you so much for coming on Bloomberg. First of all, what is the core strategic rationale of what you're trying to do with this offer that took many by surprise?
Right. I think it's quite simple to create a lot of value for all the stakeholders. I mean, for clients, because we are enlarging the value proposition, for employees, because it will be a fantastic place to develop their potential, and for the economy, because we will support companies in growing, and especially for shareholders, will be a fantastic deal, because we are rewarding them with 100% payout dividend, while keeping a strong position in terms of capital for further potential rewarding.
Now, Mediobanca has come back fighting, describing the offer as destructive. They called it too low, lacking in value. How do you respond to those criticisms?
So to measure the value is quite simple. We will have double-digit DPS growing. I don't know if double-digit dividend growth is lack of value. I think we have to see arithmetically what is the meaning of double-digit.
But are you ready to go up in the offer? Do you think you'll be able to pull this through? Yeah.
No, I think we are confident that we complete our deal. There is a strong industrial rationale, strong financial rationale. We are rewarding our shareholders for the next 10 years, 100% payout. And moreover, thanks to the fiscal benefit, we will increase the capital by 500 million each year. So there is no reason why shareholders should not be rewarding also us.
You've lowered the possible minimum acceptance threshold to 35%. Why?
We are fully determined and convinced that we will get more than 66% in the deal. Clearly, there is a technicality, that is, they have to put a minimum threshold, and 35% is the level that, in any case, will allow us to have de facto control of Mediobanca. The goal is to reach and to go above 66%.
But so this is not effectively a new target. It's more like a fallback option.
Yes, it's exactly full. It's a technicality. It's clear that we should put it also as a requirement of authorities, but the goal, and I'm sure, I'm confident, we will get the full control of Mediobanca above 50.
I mean, you're very confident. So if you get it, as you think you will, what happens to the Mediobanca brand? Does it stay?
No, the Mediobanca brand will stay, because this is one of the value that we believe is a strong value. So the nice of this project is that we are building on the value of the two brands. Monte Paschi, that is a great brand. Mediobanca is a historical brand. And we will leverage on brand, the quality and the excellent professionality that are in Mediobanca and Monte Paschi. So it will be a win-win solution. Brand, the same people, the same rewarding system increase, keeping people happy, because we will have a fantastic development path for all of them.
Yeah. I mean, I've always heard that actually in these cases, what's hard is the culture, is integrating culture. So how do you integrate that, the DNA actually of the bank, whilst doing deliverable synergies?
No, I think honestly that we will be facilitated by one common point of culture, that are customers. So the real culture for a banking that is a commercial, for investment banking, is to revolve your activity around customer. Mediobanca is doing quite well. We are doing quite well. So there will not be issue among customers, different customers approach.
Does the current Mediobanca CEO stay if you take it over?
I think he's showing that he's not interested to the deal. I called him and he didn't answer to my phone. So I think we have to look for a new CEO, and will be a brilliant guy, international guy, that will do his best in order to keep all and motivating all the current staff, attract new talent, and developing the current staff.
So you haven't spoken. He hasn't. I mean, you tried to reach out to Mediobanca, and he hasn't returned calls.
I tried, but it's obvious that it's difficult to agree on the deal now, especially in this situation.
So it's my understanding you're here in London also to meet shareholders, right, of Mediobanca. Have you had positive signs from them?
I met them, and I think feedback is quite positive, because really at the very beginning, when I came in January, the discussion was why the deal, what is the industrial rationale. Now the discussion is what is going to happen after September, when you start to have the control of Mediobanca. So it's much more proactive discussion.
Have you, I mean, also engaged with private investors, Caltagirone and Delphine, who of course play a pivotal role in all of this?
No, I think honestly they are supportive from the very beginning, but they let me deciding everything. I didn't receive any interference from my activity, and it's nice to have shareholders that let the management deciding what to do.
Can you give me a sense of the integration process? So if you look at the timeline, and finance loves timelines, so how quickly do you think you'll be able to do this, achieve this, and integrate and change everything that you want to change?
I think I have some experience in integration because I make integration in several countries in Europe. This is the most simple transaction because you are not integrating, you are combining, you are joining forces. That's why we never use the word merging, integration, because it's a simple deal from the day one. Banca with the brand will keep doing what they are doing, maybe with a higher focus, because we will be motivating them. Compass, that is making consumer lending, is already cooperating with us, will enjoy the support of 1,200 branches. Banca Premier will benefit of the engine of Widiba, that is our personal financial advisor distribution, and I think altogether we will build the third competitive force in the Italian landscape. It's a fantastic project.
But as you know, because you've done so many deals, it's never as simple as that, right? Because it distracts management into doing other things and things like that. So what do you see as your biggest challenge?
I think the big challenge is to be sure is the timing involvement of the team of Mediobanca, to have their trust, and in order to get it, it's clear that it will depend a lot of the new head of Mediobanca, and I'm confident the guy will be the one excellent personality and will keep the people around him.
Do you have someone in mind already?
No.
What can you tell us about the operational overlap?
No, operation is very limited because this is the nice of the project. Mediobanca, for the investment bank, is something that we don't have at this scale, so they will keep doing the same. Yeah. The overlapping, it's not a very overlapping, is on consumer lending. We contribute to the product factory of Mediobanca, that is Compass, and then we have an integration of the activity of personal financial advisor, Widiba, that are 500, with 600 of Mediobanca Premier. So altogether, they are doing the same job, so there is no overlapping situation.
How confident are you that, you're confident that this deal goes through, but then that the Italian financial banking system will be in a better footing? Italy has always been overbanked. Well, does this now kind of put it in a better shape, or do you think there needs to be more M&A?
I think this is a new step towards a consolidation process. So size is not anymore an option. We should increase, we should compete in European landscape, and we need a larger bank. This is the first step, and sure there will be a second wave of consolidation, and it's nice to think that we can be again a sort of protagonist of this process.
So what do you want to be? What do you want the bank to be in 5 years?
5 years from now, I think to be for sure one of the key players on the Italian market, to keep our position of third player, and to try also to extend the market in some way, even aside, at least with Compass, for example, aside Italy.
Do you believe in cross-border consolidation? Do you think Europe needs it, and will we ever get one?
I think it's necessary, but probably should be done with a different approach, by much more similar to what is Sabadell Vizcaya, no? Something that is connected with the a common operation platform, but the customer should be at the same way, follow with the same approach that has each bank doing in his country.
Maybe a final question on what you're seeing amongst your clients. So there's a lot, we talk every day on tariffs and trade and inflation. Is your customer base okay, actually?
I think yes. We are in a privileged position because Monte Paschi has 551 years, 2 years of history. And then it's clear that we have long-lasting relation with customers, very loyal, also in the different period of time. So I believe we are entering in this phase where customers, overall I'm speaking, banking sector, requires a step up in the value proposition and also in the way we serve them. Right?
Thank you so much for making the time to come to London, actually, to see us. Luigi Lovaglio there, the chief executive of Monte Paschi. Now, today, a lot of focus will be on trade and tariffs, given what we heard from President Trump, but also the inflation data yesterday out of the U.S. Nothing too worrying, but again, you see signals that a little bit maybe there's cause for concern, or certainly markets have repriced expectations of a Fed cut. Up next, Bloomberg Brief, and this is Bloomberg.